We've been lied to. From an early age, many of us were taught certain lessons about money that we were taught to be 100% fact. Rules like always save your money and avoid debt at all costs. These rules have had a significant impact on my financial decisions until I really started to learn about money and wealth on my own. And while these lessons were taught to us with the intention of keeping us financially stable, sometimes it can have the opposite effect. So I'm going to debunk 8 lies about money that are often thought of as fact. And make sure you stick around to the end to learn the true secret of how the ultra wealthy pay much less taxes than we do. Also, hi, my name is Alex and I am not a financial advisor. I just know things. So lie number 1, your money's always safe in the bank. Until I started working in fintech, I always thought my bank account was my own private account just held at the bank that they kept an eye on for me because they were good people. I thought the only way they made money from me is if I overdrafted my account or went below my balance limit somehow. What I didn't know about putting my money into the bank is that when you put your money into the bank, it just goes into this big pile of cash. And the bank is actually only required to keep 10% of that. The other 90% they can invest and lend out and do whatever they want to do with it and make more money off of your money. In normal circumstances, this is fine because there's very few times where everyone wants all their money back at once, right? So having 10% of everyone's money in the bank should be sufficient to give everyone their money back, or everyone that's asking for their money back at the time when they need it. But there are rare times when a lot more people want their money out of the bank than the bank can handle. And actually, it just happened. I'm sure by now you've heard of Silicon Valley Bank. This bank recently just experienced a bank run, which is when a bunch of depositors that put money into their bank want all their money back at one time. And of course, the bank doesn't have all their money because they're only required to keep 10%. So in this case, the bank failed. And it's actually the second largest bank failure in history, right after Washington Mutual Bank in 2008. Luckily for most of us, banks are FDIC insured, which means that when bank runs like this happen, the FDIC will guarantee up to $250,000 of what the depositor had in their account. Now, normal people do not have $250,000 just sitting in a bank account, so most of us have nothing to worry about. But there are a lot of personal accounts still and a whole lot of businesses that have well over $250,000 in an account. Even though banks tend to make low-risk investments and give out low-risk loans, the fact that they can still legally do that with 90% of the money that we give them is a little questionable. So, is your money always safe in the bank? I would say no, given the risks that they're able to take. Because at the end of the day, even if the FDIC did bail them out, they still failed as a bank. Silicon Valley Bank was holding over $212 billion and still failed. You know what I would do with $212 billion? Not fail. But are banks generally safe? I would say yes. It's probably still the safest place for us to store our money, unless you want to, strap all your money to yourself and just sleep with one eye open. Though it is usually best to store your money with different banks rather than putting them all into the same bank. That's literally putting all your eggs in one basket, right? But regardless if you keep your money in a savings account or under your pillow, another lie that we were always told is you'll be fine if you just save your money. I think a flaw in the way that we think about money is that we tend to think about money as a dollar amount rather than its value. Like when we think of $5, we sometimes think of a $5 bill, but not what $5 could actually buy us. The $5 bill never changes, but what you can buy with it gets smaller and smaller every year. Like if last year $5 got you 2 cartons of eggs, but this year it only gets you 1, even though that $5 looks the same, it actually lost value. That's the effect of inflation. So in the past few years, we've experienced higher than normal inflation, but the average inflation rate in the US is 3.8% per year. Now compare that to the average interest rate of your savings account, which is usually around 0.35% per year. That means if you put $100 into your bank account, over a year, you lose money. Here's why. This is you. You have $100 and you have the choice to buy either some new shoes or put it in your bank account. You decide to be responsible and save it. But next year, you decide that you actually want to buy the shoes. Because you put the money in your savings account, you now have $100.35 because of your 0.35% interest rate. However, because of inflation, the shoes that cost you $100 last year now cost you $103.80. So now you no longer have enough money to buy the shoes, and that's how you lose money to inflation. Now, the solution is not that you should have bought the shoes because, as we know, products lose value over time as well. Nor is the solution to stop saving money, because having cash readily available or having an emergency fund, especially in times like this where the economy is not doing well, is crucial. But instead, you want to make sure that the money that you're saving has an overall interest rate that is either greater than or equal to the rate of inflation. That way, your cash is at least keeping up with the inflation rate. So I'm not going to get into the investing side of things, but the safest and easiest way to get a higher interest rate on your savings is to put your money in a high yield savings account. Nevertheless, inflation brings me to my next slide, which is the house that my parents bought 20 years ago is now worth way more than what they bought it for. We always hear these stories about how someone bought a house way back in the day for X amount of money and now it's worth 10x that amount of money now. The current amount always seems way more than the price that they bought it for until you realize that the house just kept up with inflation. For instance, if your grandparents bought a home for $25,000 in 1970 and now that home is worth around $200,000, on paper that almost seems like a 10x increase, but in reality that home price just kept up with inflation. The average home appreciation rate in the US is around 4%. So with the average inflation rate in the US also being around 3.8%, a lot of homes just kind of keep up with inflation rather than increasing in value. Granted, for a lot of us, buying a home still makes sense, right? It's still better than putting your money into a savings account. And there's plenty of reasons why a home could actually be way worth than what someone bought it for if it's in a touristy area or a place that wasn't touristy before, now everyone wants to go there. Or there's a housing shortage and people are just willing to pay way more than the home is worth. But I do think it can be a little misleading to compare two prices of a home that are 20, 30 years apart without accounting for inflation. And not to mention all the other costs that go into maintaining a home, like repairs, taxes, etc. Even with the tax benefit, buying a home is not necessarily the investment that it's made out to be. I also think comparing home prices like this can be a little dangerous sometimes because it can make people feel like they need to buy a home by any means necessary to secure their financial future. I know for a long time after graduating college, one of my main priorities was to buy a home. And then once I realized the true cost, I chose not to. And not that I'm against it or will never buy a home, but it just wasn't the best use of my money at that time. By the way, there's plenty of inflation calculators online, but I'll link some below in the description. So, buying a home leads me to my next slide, which is that you'll never gain financial freedom if you don't buy real estate. So growing up, real estate was the only investment type I really knew. But as we saw from the last example, buying a home as your primary residence is rarely an investment. By definition, an investment is any mechanism used for generating future income. And given that the home price in the last example just kept up with inflation, means that it did not generate future income. Now, say for instance, instead of your grandparents putting $25,000 towards a house in 1970, they put that toward the stock market. Today, that money would be worth over $5 million. Now, compare that to the $200,000 that the house is worth today. Granted, your grandparents had a home to live in for 50 plus years, but that pales in comparison to what they would have gained if they put their money into the stock market. And I know you can use leverage to get a mortgage on a home while also investing in the stock market. But my point here is that you don't need to buy a home to do so. You don't need to buy a home to gain financial freedom. And that's even if you think you need to buy rental properties to generate income. And of course, there's nothing wrong with that. Rental properties are a great investment that can have returns sometimes similar or even better than the stock market. But it still requires time, effort, and huge financial risk. And you can actually still invest in real estate without buying a home through REITs, which are real estate investment trusts. REITs generally have a 10% return rate, which is similar to the average return rate of owning a rental property. Therefore, you'll still have exposure to the real estate market without having to buy real estate on your own. So you can definitely gain financial freedom without having to buy real estate outright. But regardless, you'll still want to diversify your money across multiple investment types. Okay, so before we get to the next one, can you like this video, please? It's an investment in me, and I have great returns, so it's a good one. Thank you. Okay, lie number 5. You need to be debt-free before you start investing. Having debt can be very uncomfortable, especially when it has a high interest rate or the amount is just so large that just the possibility of you losing your job and not being able to pay it just keeps you up at night. But even though debt is one of those things that you want to get rid of as soon as possible just to have that peace of mind, that can sometimes come at a cost later down the line. So this can happen when you prioritize paying off some of those lower interest loans before you start investing in assets that historically have higher interest rates every year. So say for instance, you have a $30,000 student loan with a 5% interest rate, right? You have to pay off that loan within 20 years. And if you extend it the whole 20 years, that will cost you around $200 a month for the next 20 years. Lucky for you though, you can almost guarantee that you'll have around $400 to both invest and pay off your debt for the next 20 years. So say you decide you want to hurry up and pay off your loans first and then invest in the stock market. With that $400 a month, it will take you about 8 years to pay off that loan. And then after 8 years, you'll have another 12 years to put that $400 towards the stock market. And of course you have more time than that, but I'm looking at a 20-year span right now. So after the 12 years, you'll have about $95,000 invested. However, if you instead decide to simultaneously pay off your loan and also invest in the stock market, that would mean $200 a month going towards your loan and $200 going to the stock market for 20 years. After those 20 years, you'll have around $114,000. That's about a $20,000 difference from not paying off your loans early. Though this is one specific example, you're gonna have to run the numbers for yourself to see if and how this works for you. And for the sake of this example, I kept it very simplified and also use a 8% return rate for the stock market, even though generally it is 10%, but because we don't know what the future holds, I went the safe route. Now, there's plenty of benefits to paying off low interest loans early, like the freedom of not owing anything to anyone. And for many people, it makes sense to pay off debt so they don't have to worry about it over an extended period of time. But not only can you invest while also paying off debt, sometimes it can put you in a better financial position than just prioritizing paying off the debt first. So when it comes to personal finance, debt is not always bad. It can be a tool, but I feel like you can think of it as like a knife or a blade. If you know how to use it, you can move way more efficiently than you would if you're just using your hands. But if you're not careful, you can actually cut yourself pretty deep. Okay, so lie number 6 is having one good job is always better than having multiple jobs. Having one good job is always better until one day you try to log into your work computer and you can't get in, then realize you've been laid off during a recession, also during a time when companies are not hiring and also doing their own layoffs. Then having one good job is not really that good. In cases like this, people that already had their own side hustle or other income streams were in better positions than the ones that didn't. And listen, I am not trying to perpetuate hustle culture or tell you you need a side hustle. But the unfortunate reality is that we can work really hard at a job for a very long time and our employer can also get rid of us at any time that they want to. And if you don't have the right amount of savings or another income stream to back you up, you could be in a tough position. Though there are cons of having multiple jobs too. Like you have to work longer hours, sometimes you're unhappier, you might not be able to spend time with friends and family. There's plenty of cons with that. So the true statement is that one's not really better than the other when you think of the other aspects that go along with it besides money. But I do think there's an unfair stigma towards people that have to work multiple jobs to pay their bills, because the reality is if you have one job that's paying your bills and you lose that job, then a lot of us can't pay any of our bills. Okay, so lie number 7, wealthy people have no debt. So we always hear about these billionaires like Warren Buffett that pay very little taxes. And there's plenty of ways that they can reduce their taxes, either by maximizing their tax deductions or living off of their investments, because investments are taxed differently than income. But a strategy they use that's not as well known is called buy, borrow, die. It's a little complicated to understand, but I'm gonna try to make it as simple and concise as possible. So bear with me. Okay, so say Jeff Bezos owns a house that's worth $20 million. He decides that he wants to completely retire and live off of the equity of the house. He could sell it, but that would mean 2 things. 1, he couldn't pass it down to his kids. And 2, he'd have to pay capital gains tax. So if he bought the house for $15 million and then wanted to sell it for $20 million, that means he has a capital gain of $5 million. And let's say he's held it for 10 years. That would mean that he would have to pay a 20% tax on that $5 million, which would be around $1 million. But instead of selling the home and having to pay that $1 million, he instead decides to get a loan against it using that house as collateral. So in simple terms, he went to the bank and was like, yo, let me get $10 million. And if I can't pay you back, you can take my house. And the bank is like, sure, we'll give you $10 million, but we're gonna make you pay a 2% interest. And JB's like,
you need to move Lonzo. That ain't no problem. Huh?
But here's why. One, he now has $10 million available to him completely tax-free. And he can live off that money for the rest of his life and never pay taxes because you don't pay income tax on a loan. And two, a 2% interest rate is very low. That means instead of him losing his home and having to pay that $1 million capital gains tax, he now only has to pay $200,000 in interest. And JB's not worried about $200,000 because that's easy money for him. For us regular people, that's like borrowing $100 and having to pay $2 in interest. Like, we can scrounge up some $2. Okay, now here's where the die part comes in of the buy, borrow, die. Now, let's say he dies 10 years later. His kids now inherit all of his assets, and this includes his $10 million loan. But luckily for his kids, his assets continue to appreciate while he was spending up his loan money. So his kids actually inherit more money than the amount that he had at the time that he took out the loan. And not only do they have more than enough to pay off his loan, but they can also do it tax-free, because when you inherit assets, it's almost like you just got it for the first time. That means there's no appreciation on it and therefore no capital gains tax to be paid. This is called the stepped up basis, by the way. So it's a lie that wealthy people have no debt. A lot of times they have what we consider good debt because they use debt as a tool to make more money and pass on generational wealth like our friend JB did. Most of us learn debt as a bad thing because we weren't really taught how to use debt in a way that's beneficial to us and end up way over our heads. We're more familiar with bad debt, like from high interest credit cards. Which brings me to my last slide, which is gonna sound like I'm contradicting myself, but just hear me out. Lie number 8, credit cards are bad and should be avoided at all costs. Okay, so credit cards aren't bad. We're actually bad. We're bad at not overspending. Credit card debt is actually one of the worst debts that you can accumulate just because of its high interest rates. The average credit card interest rate is around 19%, which means if you use your credit card to pay $100 and don't pay it back before that payment date, that $100 can easily be $119. So credit cards are bad when you carry a balance. But if you are able to pay off your credit card every month, it actually can save you a lot of money with all the points that you can accumulate. There's tons of credit cards available these days and they all offer their own variety of perks. For instance, there's cards where you can get extra points when you spend on groceries, travel, gas, hotels, pretty much anything, honestly. And if you use your points optimally, you can use your points to pay for things that would cost way more if you just paid in cash. Like, you can literally book flights around the world with your credit card points, depending on the credit card. And I won't get into all the details about that, but there's an entire industry of optimizing your credit card points. And if you're new to credit card rewards, I would suggest going to thepointsguys.com, and that's a good place to start of just learning about the world of the things that you can redeem for your credit card points. I'll link that in the description as well. So credit cards are simple. If you don't pay them off, you're punished. And if you do pay them off, you're rewarded. So I hope this gave you a different perspective of some of the common money lessons we learn growing up. As I mentioned earlier, a lot of these lessons were taught with the intention to keep us safe from making bad financial decisions. But sometimes being too safe can be just as detrimental to our financial health as taking on too many risks. So in the end, it really comes down to finding a balance between your own risk tolerance and your financial goals. So if you enjoyed this, please like the video and subscribe for more videos like this. Bye!